Staying with the Fed, our next guest says potentially there is no rate cut in 2024, but around one might feel right. Joining us now is DoubleLine Deputy Chief Investment Officer Jeffrey Sherman. So you think they're going to get one cut this year, Jeff, or none?
Yeah, I mean, if they do, it's going to be back into the year. As you guys have been discussing right now, I mean, the inflation story is just not being accretive for them to set up for the rate cut at this point. And I kind of think Powell pinned himself down a little bit yesterday, saying that he doesn't believe that the next move is a hike. He doesn't think that's very likely. But I think he should just stay where he is right now. And as we see, the economy's done relatively well. Yes, first quarter GDP was a bit disappointing, but when you look under the hood, the consumption is still there. And so if you think about the drivers of inflation and what the Fed is trying to do to their transmission mechanism of policy is that they want to make credit more expensive. They've done that, right? We all agree with that. But the one thing they haven't done is curtail spending via an increase in savings rate. And thus far, that's been the part that hasn't really slowed down like the inflation narrative. And so as you look at it, we're still consuming things. We're just doing it in a service capacity versus a goods capacity. And so when you look under the hood in inflation, it's really services. And that's just going to take some time. And as you're talking about it here with the calendar, we're running out of time to get the number of cuts that are in the dot plots, those 3 cuts. So, I think one feels right. There's a chance that it's 0 at this point. And look, what I hear from the Fed chairman is good. He's saying that he's willing to wait on the data and not be committed one direction or the other. And I think that's what the market has to realize.
So what does it ultimately mean for bonds? If you don't know exactly what's going to happen with the path of inflation or rate cuts, Jeff, what do you do? Do you think we've seen the highs on yields for the year, or are you expecting them to march higher?
Yeah, I'm not sure we've seen the highs yet, because I think that, again, this tends to be the seasonal part of the year where we get more increased consumption as the kids get out of school, people take the summer vacations and the like. And so I think what you're going to see here is it's going to be a choppy environment in yields. And so what that means is that you're going to earn the carry, right? You enter into a bond and you know what the yield is on it. And so there's ways of putting this stuff together where you can have some protection in case bonds rally. If they do rally, it's probably later in the year. And so in the interim, you're paid to wait. And so you can sit on the front of the curve. You can pick up spread and stuff like some floating rate assets that give you some protection if indeed, let's say that the Fed does have to engineer a hike at some point, or if they just stay higher for longer, as we keep talking about. And I think in general right now, you don't need bonds to rally to make money. And so if you can put together the portfolio, we've been talking about this every time I come on this show. Portfolio you can put together, it yields like 6%. Yeah, it has some choppiness in terms of its return because of yields. But in general, if you look at where you've been over the last 6 months, you've earned more than just the carry there. And so I think having some kind of selective credit in the portfolio, not getting too risky at this point, and not be wedded to one direction or the other is absolutely the right outcome. And you can do that across various parts of the bond market today.
Jeff, I wonder what your thinking is right now regarding excess savings. I mean, we'll worry about the labor market tomorrow, but do you really believe that it is run out for various cohorts and that's what's driving, at least anecdotally, this idea that the consumer is getting price weary?
Yeah, I've always had a trouble with the phrase excess savings. And as I've been telling our clients and when we go talk to them, if you have any excess savings, just please send them to me. Not to DoubleLine, but to me, Mr. Sherman, because I don't have any excess savings. I just have my own savings. But I do think that you're seeing it has run out for those bottom cohorts because we haven't been sending out the money again in these rebates or these stimulus programs. But also the thing I think that's having a degradation on the lower income strata is the cumulative inflation effects. And so we sit here in the financial markets, we talk about year-over-year effects. But what I think is really built up, and you're seeing the stress on the lower income and the lower credit cohorts, is that cumulative inflation, right? And so people anchor to something prior to the pandemic. And if you look at that, prices are up over 20% over that period. And that's obviously going to be a regressive tax on those lower income strata and those lower quality borrowers. And so that's where you're seeing the deterioration. But in aggregate, you're not seeing that. And so that's what we're mindful of when we're looking at credit. We're looking at that kind of bottom income side. But thus far, they're still surviving, and it's all predicated upon that labor market. And so obviously tomorrow's jobs number is important. But again, whether it's above expectations or below expectations, if you're printing something north of 150,000 jobs per month, that is something that's very accretive to the overall economy. And so we have to be mindful of looking beneath the surface of the data. But at this stage, it hasn't been problematic to date.
You know, I haven't even talked about what's going on with the Japanese yen, which is also pretty crazy. I mean, yesterday, super early in the morning in Japan, late afternoon here, it looks like the Japanese took the opportunity to intervene again for the second time. This is clearly going to cost them a lot. So they've knocked it from dollar yen from 160 down to 154 or so. What do you do? Would you fight the Bank of Japan? Are you guys buying dollar right now at DoubleLine?
No, I don't want to fight a central bank ever. They have more firepower than we have here at DoubleLine, so that's not my base case. But at this stage, I mean, they took the opportunity with kind of that weakness in the yield market yesterday to really step in after Powell. And so I think they were worried about the hike, and they didn't want to use the firepower prior to the Fed meeting. And so there's definitely the intervention there. This is the second time they've done it over the course. And really, 155 was that line in the sand number, and we got up to 160. Yeah. So at this stage, I don't really want to fight the yen. I don't want to play the yen. Look, the dollar is the place to be today. We have a lot of yield advantage to the rest of the developed world. We are the carry trade, as people will say. And there's no, as a U.S.-based or a U.S. dollar investor, there's really no need to be messing with these other currencies at this stage, given how much yield is here in the U.S.
Yeah. So you think the strong dollar continues, but you're not necessarily putting a big call on it?
Yeah, Sarah, I wouldn't fade the dollar at this point. I think the dollar is strong because I think rates are either poised to stay in this range or potentially go up a little bit from here. And so from that standpoint, I don't see the catalyst to getting the Japanese rates up higher. I don't see the catalyst for the Eurozone rates higher, and really even a catalyst for the British pound to be higher. So from that standpoint, it's really difficult to want to fade against the dollar at this stage. And again, if you're a dollar-based investor, why even mess with it? You get paid to invest here in the U.S. today.
Okay, Jeff, thanks for joining us. Some of the
All
takeaways
right, thanks, Sarah.
from
Great talking
Powell.
to you.
You too, Jeff Sherman from DoubleLine.